Good morning, everybody, and welcome to our webinar on changes to the charity SORP. My name is Kirsten Hogg, and I'm Head of Policy and Research here at SCVO. I'm just popping up very briefly while the last few people make their way into the session this morning to welcome you to the webinar on behalf of SCVO and to explain the format that we're going to follow this morning. Before I do that, I just wanted to let you know that we are recording today's session so that other people can catch up afterwards, or if there's anything indeed that you want to check up afterwards, that will be available for people to have a look at. So although it's really nice for us as speakers if we can see your smiley faces, if you don't want to be filmed for any reason this morning, then please do feel free to have your camera off. Very shortly, I'll pass on to Rory McCall. Rory is Director of Audit at one of our partners, WBG, and he's going to talk you through the proposed changes to the accounting regulations in the Statement of Recommended Practice for the Charities SORP. The purpose of the webinar is primarily to get you up to speed with these changes so that you can start to think about what they might mean for your organisation. Rory's going to run you through the changes and we'll send on a copy of the slides after the event so that you've got those as well. There will be loads of opportunity for you to ask questions. Rory will pause to ask if you have any at different points throughout his presentation, or if you prefer to add them to the chat, then we can pick them up that way. It's important to note though that the changes that are being talked about today are not all yet set in stone. Some of those are being consulted on. Some of them are fixed as they're being brought into line with other accounting standards, but the SORP making body is currently seeking feedback in relation to some aspects of the proposed changes and on how those changes are being communicated to charities. SCVO is going to be submitting feedback as part of that consultation, and we need your help to do that. So we'll be asking some questions at various points throughout the presentation where you can submit your own questions through the Menti website. I'll pop the link to that in the chat in just a second, or you can join us on Menti directly at menti.com and using the code 25281651, which I'll also put in the chat just as soon as I finish speaking, because I can't put it in the chat and talk to you at the same time. That's way too much for me. Rory will let you know when it's time to flick over to Menti to have a look at those questions. So if you can maybe take a moment to get that set up either on your phone or on another web page, that would be great. We'll be responding to those questions as we go, and I'll send over the results from that afterwards in case you're interested to know what your other colleagues on the webinar think of the information that's there. As well as contributing to SCVO's response to the consultation, you do have the option, of course, to send your own thoughts directly to the SORP making body, and I'll put the link to the consultation in the chat as well. The closing date for that is Friday the 20th of June if you're dead keen and you'd like to submit your own consultation. But now, without further ado, I'm going to hand over to Rory, who's going to take us through the majority of this morning's session.
Thank you, Kirsten. As Kirsten's mentioned, I'm Rory McCall. I'm a Director of Audit at WBG, who are a firm of accountants based in Glasgow. What I'll do today is I will run through primarily the technical side of things, just to give a bit of an education piece on where some changes are going to be. I think one of the key things to say is, as Kirsten has already mentioned, changes are in the early stages at the minute. So this is going to be new to everyone. There are some things in the new charity SORP which is going to be staying the same. There are some things which have changed fairly significantly. So as Kirsten says, there's plenty of areas where this can still change. There are plenty of areas which are new to me, which will be new to yourselves as well. But hopefully there will be some use to what we're doing today. So just to run over briefly what we'll be discussing. So first I'll give a brief overview of why the charity SORP is being revised, what the expected timeline is, and what's actually being consulted on. I'll then give an overview of some of the key changes to allow everyone to understand what the existing rules are, where they're changing, and what specifically the SORP making body are looking to consult on. Whilst I'll absolutely try my best to explain as clearly as I can the core technical changes in each area, there are a number of areas which are being consulted on where some detailed reading of the new requirements may be fully required to understand all the key changes in detail. The new SORP document is over 300 pages long, and each specific module within that is around 20 to 30 pages and includes quite a lot of technical detail. So unfortunately, I don't have time today to go through every single module and change in full detail. There may be some assumed knowledge in certain areas today. However, the consultation itself does make allowance for those with less experience and their response questions. So contents there, some areas in front of you which are changing. If there are any areas which aren't fully clear, we will have time for questions today. If there are any burning questions, I'm happy that someone shouts out to me as we go. But when we stop for the consultation questions themselves, I will allow people to jump in and ask anything specific they want on the technical content. So why is the SORP changing? Well, firstly, most companies and charities in the UK have to adhere to Financial Reporting Standards 102, or FRS 102 for short, which are essentially the accounting rules for UK-based entities. These rules determine how an entity has to report its results and the various disclosures which they have to include in their accounts as well. There are, however, separate rules which apply specifically to charities. In Scotland, there are two key legislative sources which charities have to adhere to, which govern what they have to put in their accounts. And those are the Charity and Trustee Investment Scotland Act 2005 and the Charity Account Scotland Regulations 2006. Thankfully, that's probably the last time I'll actually make reference to those pieces of legislation this morning. I'll try not to bog everyone down in the details of those. But they do govern much of the statutory information in charity accounts, as well as some aspects of the trustees' report as well. They also say that charities must prepare their accounts in compliance with the charity SORP, which is an interpretation of FRS 102 specifically for charities and include a lot of the charity-specific disclosures. What's key to say at this point in time is that last year, big revisions were announced to FRS 102, which applies to almost every entity in the UK. As the charity SORP is an interpretation of FRS 102 for charities, it then has to be updated to ensure that it's consistent with those rules in FRS 102. Periodic updates to the SORP also provide an opportunity to respond to stakeholder feedback in specific areas as to where they might like to see some change too. So what is going to be the revision timeline? Typically, the rules are revised every now and again on a cyclical basis. The Financial Reporting Council, who are responsible for updating FRS 102, usually aim to update it every 5 years or so. FRS 102 was first introduced in 2015, and then the most recent revisions took place in 2019, and this is the first significant update since those new rules were brought in 2019. As I mentioned previously, the revisions to FRS 102 were announced last year, and that was in March of 2024. And as a SORP is an interpretation of FRS 102, the SORP making body had to wait until those changes were formally announced until they could start working finalising the revised SORP and issuing that for comment. So the revised SORP was issued for comment about a couple of months ago now, and that's the main reason why the SORP has been issued a lot later than those changes to FRS 102. Ultimately, the aim is to have the SORP finalised by around about the autumn of this year. That will then take effect for accounting periods commencing on or after the 1st of January 2026, meaning the first accounts under the new standards will be up to the 31st of December 2026. So actually a lot of these changes are then not actually going to be implemented until we start preparing those accounts in early 2027. So what is being consulted on? The charities SORP to some extent being driven by what's in FRS 102. Many of the technical changes included in the charities SORP are essentially following what's in FRS 102. These documents need to be consistent with each other as far as possible. They can't contradict each other in non-charity specific areas. The SORP needs to be an interpretation for charities of what's in that document. So as such, whilst the SORP making body are consulting on the understandability of many matters. There are many technical areas which I'll discuss today where they're not seeking an opinion on the actual technical changes themselves. They're more asking for a gauge as to whether they're understandable for users of the SORP and are deemed to be appropriate. There are, however, some charity-specific changes, such as a new tiering system for charity sizing and the content of the trustees report. These aren't driven by FRS 102. They are primarily driven by charity legislation and the SORP itself. So the SORP making body have a wee bit more leeway in those areas to make amendment based on consultation feedback that comes out of this process. Regardless, it is important that a wide range of opinions are sought to ensure that as much appropriate feedback is gathered as possible. If additional guidance or narrative is required in certain areas, then the SORP making body may likely amend the documentation to provide that additional guidance. So the first big area of change which we're going to see in the new SORP is in relation to charity size classification. This is a fairly substantial change, and there are plans to introduce what's called a new tiering structure to classify the size of a charity. Why does size matter when it comes to charities? Most substantially because it is a big factor on what's disclosed in a set of accounts and how things are laid out. For charities, some numerical disclosures are more extensive and transparent for larger charities, and larger charities are required to include a lot more detail on their activities in their trustee report. There's a significant focus on trying to make things simple where possible for the trustees of smaller charities, whilst trying to provide an appropriate amount of detail on its results and how it actually achieves its aims. Under the current SORP, charities are either deemed to be small or large, and there's no in between. If a charity has income of less than £500,000, then they're deemed to be a small charity. If they have income of more than £500,000, then they're deemed to be large. What the new SORP is proposing to do is essentially dispense with the distinction between a small and a large charity, and they're moving to what is now a 3-tier sizing model. And this will primarily lessen disclosure burdens on the charity in the lowest of those 3 tiers. So the proposed new tiering structure is that the smallest of the charities, those with income of less than £500,000, will now be classed as Tier 1 charities. Those are charities which are currently classed as small. Those over the existing large charity threshold of £500,000 will now be known as Tier 2 charities. And there is then a new 3rd tier for the largest charities who have income of more than £15 million. On the face of it, there's not a revolutionary change here. And you'll see, obviously, that previously it was small, less than £500,000, large, more than £500,000. Essentially, what we're doing is just adding a 3rd tier on top of what's already there for those with more than £15 million of income. However, there will be a few changes in terms of what actually has to be disclosed to mention. Firstly, with the emphasis on small charity reporting, there will be some reduced disclosures for the Tier 1 charities. This is one of the areas where some background information and reading may be required separately. The structure of the SORP module in the trustees report has been changed to provide a table to show which sections apply to each tier of charity to make it abundantly clear as to what disclosed, and I will show that in a minute. There are therefore some clear disclosure exemptions focused at each tier of charity with a progressive approach, meaning that Tier 3 charities are going to be required to disclose the most. Accounting disclosures will also vary on the back of this, depending on which tier a charity falls into. There's not so much of a substantial change there. However, typically financial disclosures will become more transparent as a charity goes up the tiers. There are generally a huge amount of areas where this may impact on, so I can't run over every single potential change today. However, what the SORP making body are generally trying to consult on is whether the tiers are appropriate, whether they provide clear guidance on what has to go into each set of accounts, and also whether they provide relevant and appropriate disclosure requirements for small charities too. So this is a brief extract from the new SORP from the trustees report module of the SORP to give some overview on how this will work practically. So that this table is a sort of guide as to what each charity is going to have to include. So you'll see at the top, we're distinguishing between tier 1, 2, and 3 charities. Down the left-hand side in this table is each of the various different headings which the charity SORP defines as must be included in the trustees report. And you'll see that under each heading, it discloses which specific sections of the trustees report module need to be included. So if I look at, for example, the achievements and performance line there, you'll see that for tier 1 charities, there is only one disclosure which they have to include from that specific area of the SORP, section 1.28. If you're a tier 2 charity, there are 6 that you have to include, sections 1.28 to 1.33. And if you're a tier 3 charity, there are 7 different areas that you have to include, being section 1.28 to 1.34. And that's generally quite consistent across most of those headings. You'll see that in pretty much every instance there, tier 1 charities are having to include less information than tier 2, and tier 2 charities are, in most instances, but not all, required to include less information than tier 3 charities. And essentially only tier 3 charities will be required to include all of the requirements of the trustees report. So that's where the change to a sort of tier structure is probably most apparent in the trustees report. As I say, there will be some changes to financial disclosures there, but this is probably the key area that affects is your trustees report. So this is probably the first area where, as Kirsten had mentioned, we'll be looking at some of the consultation areas. There are 4 key consultation areas in respect of the tier reporting. The first areas are reporting requirements for the tiers clear? If not, what are your questions? Do you support the move to a 3-tier model? Are the thresholds at the right level to support proportionate reporting? And lastly, should the largest charities be referred to as tier 1 or tier 3 charities? This is probably a good area where if anyone's got any relevant questions on the tiering model or the specifics behind it, I could answer them at this point.
Rory, I think someone's put a question in the chat there, and somebody was also just about to come in, I think. So hopefully we've got a few questions. Just to say with the Menti, I'll move on to the second question just after allowing a couple of minutes for people to submit if they've got any questions on that first question that they can see on the Menti page just now. And I'll move on to the other questions just as you're covering those questions off there.
It's fine, yeah. So there was one about whether there's likely to be a discretion or a grace period for charities who just meet the threshold. So, for example, if they receive a large capital grant, I think based on how the SORP currently works, I think that's unlikely. It tends to be fairly.
I'm on mute and all that stuff. The charity law is changing.
Yeah, so to address the potential grace period, I think that is unlikely. The way that the SORP works is that each financial year is considered on its own. That's driven by charity legislation. So if a charity goes over what is currently the £500,000 threshold, they are required to address that in the year in which they breach that threshold. So if you receive a large capital grant, which has your income over one of the tier thresholds, that will be the case that you have to adhere to that tier in that specific year. You won't get a grace period. What it does mean, the flip side, is if you then fall out of that in the subsequent year, you will be allowed to go back down to, say, tier 1 immediately. If you breach into tier 2 in 1 year, and the following year you are classified as tier 1 again, you should be allowed to go straight back down onto that tier. So that's the way that currently works, and I don't think they're proposing any changes to that at present. That's Fine. I think that's the only one I've got up in terms of questions at the minute. Is there anything else which I'm missing, Kirsten?
No, I don't see anything else in the chat. Sorry, I'm just moving on to questions 3 and 4, but they'll be much quicker. Just sing us a song.
Yeah, that's fine. If any more questions come in, I'll take them. But if you want to let me know once we're through the queries.
For anyone who's not managed to find us on Menti yet, we're just on question 3 there. Are the thresholds at the right level to support proportionate reporting? So far, the answers to questions 1 and 2 have been that yes, people by and large think that the reporting requirements for the tiers are clear, which is great to hear. And that yes, also people support the move to 3 tiers. So that'll help to inform our consultation response. A little bit more split on whether or not the thresholds are at the right levels. So that's good, gives me something a bit meatier to report back on. And I think we've nearly got everybody's responses there. So I'm going to just move on to the last question. Should the largest charities be tier 1 or tier 3? Get your semantics hats on. And then I'll let you know when we've got votes in here. I think I can just leave that one up there, Rory, if people want to comment on that as we go on probably my favourite ever consultation question. And I've seen a lot of them, but that's probably...
The one about tier 1 or tier 3? Yeah. I did laugh when I saw it, but...
Fabulous. Thank you so much.
I feel I need to ask it. Okay. That's fine. I'll move on to the next area then.
Yes, please.
Yeah, okay, that's fine. One of the other big areas we're going to be seeing a bit of change on is the content of the trustees report as well. Whilst there are aspects of the trustees report which are driven by charity legislation, the charity SORP is a key driver of what has to go into the trustees report. It does set out the key headings and the more detailed content which it's required to cover. Under the revised SORP, a lot of the content of the trustees report will remain consistent with how it was previously and will broadly be set out into the 6 key headings detailed on screen. When we were covering the tiering a minute ago, those were the areas that I sort of drew on there. So that's reference and admin details, structure, governance and management, objectives and activities, achievements and performance, financial review and plans for the future. So they're not going to change. The content will remain broadly consistent with what we'd seen before. The new tiering system is going to interact with those headings, meaning depending on the tier your charity falls into, the more or less content you're required to provide in each of these areas. However, in response to user needs, there have been a handful of areas which have been expanded upon or added in under the new SORP to help enhance and improve reporting. So the 2 areas which you see on screen, impact and sustainability reporting, are new under this revised version of the SORP. Charities are increasingly required to explain the impact that they're making. As all charities exist to provide a public benefit, it does sort of follow that they should be able to communicate the benefit provided to the beneficiaries that the charity is required to serve and support. The SORP engagement process highlighted a strong desire for charities to report on the difference that they're making, and so consequently the charity's wider impact on the environment also now forms part of the considerations that the charity trustees must make and report on. For this, exact requirements will vary for tiers 1, 2 and 3 charities. However, broadly speaking, the trustees report may now need to include the impact that the charity is making. We must consider the long-term effect on its activities, on individual beneficiaries and on society as a whole. A summary of the measures or indicators used to assess performance. An explanation of the outputs achieved by particular activities, especially when numerical targets have been set. For example, the number of beneficiaries reached by a particular programme, or the number of events or interventions planned as part of an activity. and information on activities, outputs and impacts in the context of how they've contributed to the achievement of the charity's aims and objectives. It was acknowledged in the engagement process that stakeholders are increasingly interested in how charities are responding to environmental, governance and social issues as well. To reflect this and to advance reporting in this area in a proportionate manner, the revised SORP is proposing that charities in tiers 1 and 2 are encouraged to explain how the charity is responding to and managing environmental, governance and social matters. Charities in tier 3 are required to explain how the charity is responding and managing environmental, governance and social matters as well. And that means, so environmental matters, the report could include details of key performance indicators used to assess progress against targets, used to manage climate-related risks and realise climate-related opportunities. And in terms of governance and social matters, reporting may include details of social opportunity, privacy and data security, board diversity and business ethics. There's a couple of new sections there. Volunteers, some new requirements in respect of that. Volunteers obviously help charities carry out their activities and achieve their purposes. It's often difficult to produce financial information on volunteers and to obtain a reliable measurement of volunteer time for recognition in the financial statements. But the SORP making body consider this information to be important in terms of telling the charity's story, in terms of how volunteers have assisted with that. Most of the current content in volunteers is restricted to reporting for larger charities, so those currently with income of more than £500,000. The revised SORP extends the application of the existing requirement for larger charities to provide a narrative explanation of the scale and nature of activities undertaken by volunteers to charities in all tiers. So this is now going to be a requirement for all tiers to comment on how volunteers interact with the charity. In relation to general volunteers, the SORP making body also proposes that the charities in tiers 2 and 3 should provide information on the number of volunteers, and where practicable, the contribution of volunteers may be expressed in terms of full-time equivalent hours. Now that doesn't mean that we're going to be including a cost of these potential volunteers' salary, what they would have been paid if they were employees. It's more just how many hours that they've helped with in terms of contributing to the charity. Some changes on reserves too. Reserves generally, I presume most people here will be familiar with the concept of reserves if you are involved with charities, but these are funds that a charity has readily available to spend on any of its charitable purposes. The current SORP has a full description of how these are calculated, being your total unrestricted funds, less anything in designated, restricted or endowment funds and fixed assets. Charity reserves are an area of interest to stakeholders, but there is sometimes a bit of a lack of understanding about the meaning of reserves from a charity purpose. This issue was clearly identified in the early engagement activity undertaken. It was agreed that improvements needed to be made to how reserves are defined in the SORP and how the disclosure requirements are explained. So the revised SORP proposes an updated definition of reserves and the glossary and more clarity about the relevant disclosure requirements for the trustees' annual report. There is also now a requirement where if the figure for reserves in the trustees' report is not consistent with the accounts, then the charity must now provide a reconciliation of those two figures as a separate note as well. Where a charity has no reserves, it must now explain how it's a going concern as well. So if a charity is sitting with no reserves available to it, the new SORP is going to require that charities explain why they feel that they're going to be able to continue for a period of at least 12 months, given that they're essentially saying that they've got no financial reserve available to them. So that's another new requirement as well. A couple of other areas too, in terms of future plans. in the existing SORP, there's a requirement for larger charities to provide a summary of the charity's plans for the future. This requirement has now been extended to charities in all tiers. It's felt that this information would be beneficial to encourage transparency and allow relevant stakeholders to be informed of the charity's future plans. And lastly, in the trustees report, there's a new requirement included for Tier 2, Tier 3 charities to provide a narrative explanation of how legacies are included in the accounts. The aim of this is to help users of the accounts to understand that a legacy may be recognised as income before the resources are received. There are some other changes in respect of legacies, which I will touch on later, but some sort of small additional disclosures in the new trustees report to provide additional clarity on when legacies are included. So, in terms of the consultation on this, there are a number of consultation questions included here. What we're not doing today is specifically consulting on each of these areas as part of the Menti poll. However, I would encourage everyone involved today to have a wee bit more of a look at what the requirements of the revised trustees report are in a wee bit more detail. And there is then an opportunity, if you do wish to submit your own response to the consultation, to answer these 8 questions which are on screen if you have any particular feelings on them. So they're mainly touching on whether you feel that prompt questions will help trustees to develop their annual report. Do you agree that the requirements which I've just discussed are proportionate for each tier? And do you feel that the guidance which is provided in respect of those areas is relevant and helpful? So those are the areas. As I say, we're not specifically consulting on those today, but those are areas which you can include in your own consultation if you wish to do so. So a few questions coming in here. Just looking at them, just a couple of basic questions. I think, is the trustees report is the same as an annual report? There is a slight distinction between them. Your annual report is probably usually defined as your wider set of financial statements, so that your trustees report is usually the bit that sits at the front of it, which is the sort of wordy section which explains what the charity does, what its objectives, its activities are, so on and so forth. The annual report is then usually the trustees report plus the numbers at the back, so your statement of financial activities, your balance sheet, your associated notes, and usually would include an independent examiner's report or audit report as well. So they're both part of the same document. Trustees report is just a specific section of your annual report. There's also another question there about will volunteers include board and trustees? It's a good question. It's not one which I feel is specifically considered within that. My gut would have said, based on existing requirements, that the board would probably be excluded from that. I feel it's usually just general volunteers, given that all charities essentially have to have a board of trustees in place. Usually there wouldn't be a specific explanation about the detail of how they assist with that, but it may be something for us to clarify separately as a good question.
Yes, having said that, I wouldn't respond to this bit of the consultation on behalf of SCVO. I do think that's an incredibly good question, and one that we'll feed back to the SORP making body isn't clear in the information that's there. So thanks for that.
Are there any other specific questions on the trustees report before I move on? Okay. If there's anything else which comes up, I can address them later on. So a couple of sort of smaller areas of change here. The next area is in respect of the statement of financial activities. The statement of financial activities is essentially your income and expenditure statement, which sets out all the income that is received during the year, and all the expenditure which the charity is disbursed with. And a charity would call that a statement of financial activities. It's not really a huge change here. In fact, there's barely any change at all in terms of what we're actually disclosing. However, helpful just to explain it. One of the key distinctions between a charity and a company set of accounts is the way in which they report their income and expenditure. In a company, it's usually known as a profit and loss statement. However, in a charity, it is known as the statement of financial activities. The charity SORP typically requires that income and expenditure is reported by activity. So usually in a company, we just say, here's what your turnover is, here's what your cost of sales are, here's your profit and loss. In a set of charity accounts, we have to break things down by each charitable activity, the source of the income, trading activities, investments, so on and so forth. At the minute, depending on their size, charities can either report under what's called the activity basis, where they report under a prescribed format using fixed headers, or what's called a natural basis, where they may use its own choice of line descriptors as long as they are useful. Tier 1 charities will have the option to use either basis, so either activity or natural basis. Tier 2 and 3 charities must use the activity basis, I should say, sorry. The new SORP isn't really proposing any great change to the existing rules. The key change is the inclusion of guidance under how to report each basis, along with an illustrative example to help Tier 1 charities to decide on an appropriate basis to use. Primary consultation focus here is whether the illustrative table on the next page is helpful. So this is the table that you will see in the revised charity SORP, which can be used to help Tier 1 charities decide whether a sort of natural basis is appropriate. As with all charities at the top, you will see that we have to report based on unrestricted, restricted, and endowment funds. Down the left-hand side, we report income and expenditure under various different categories. For Tier 2 and 3 charities, those headings of donations and legacies, charitable activities, trading activities, investments, and other are fixed. However, for Tier 1 charities, they can use their own descriptors there if they so wish to do so. However, this table is essentially giving Tier 1 charities a steer of what sort of headings they might want to use. So you'll see down the left-hand side it's saying, for example. So you may want to use those headings for income and endowments. For expenses incurred, you may want to use headings such as this to report your expenditure for the year, but it's not required. You can do that based on whatever headings that you wish to do so. Now that is really the only change of significance here, is that this table and a bit of additional guidance has been included. And the consultation in this area is primarily on whether the example table is helpful. So that's the key area, which I think the Menti poll is going to address, that Kirsten will have in front of you. Just looking at questions whilst we go, I think there was one about the increase in overheads. I think, Kirsten, you've addressed that by the looks of it.
I've addressed it insofar as it's possible for it to address it. It's an ongoing issue relating to this and all sorts of other regulatory aspects that people are asked to respond to. I was just typing a response to the follow-up question of whether there's additional grant funding for this area. Certainly there isn't anything coming forward from the SORP making body or from anybody specifically in relation to the SORP. Some funders, as we know, are more amenable than others to funding overheads. So it is, I think, an ongoing area of that certainly SCVO is trying to influence on, and I'm sorry I don't have a magic wand to make that better for people. The example table almost unanimously is being reported as helpful from those who've completed the Menti, so that's great. I'll just move on to, I think, is there a second question on the so far, am I right?
Don't believe so.
There's not. Okay,
There's not.
then I won't move on. Super, thank you.
Okay, that's fine. Okay, that's fine. Yeah, so the next area, again, this isn't somewhere which is going to be too significant in terms of change either. And from my point of view, as someone who prepares a lot of sets of accounts, it's quite a welcome change. And it pertains to the cash flow statement. For anyone that's unaware with what a cash flow statement is, it provides information about the ways in which a charity uses cash generated by its activities and about changes in cash and cash equivalents held by a charity. It also provides information that's helpful in assessing the charity's liquidity and underlying solvency as well. It essentially reconciles where a charity has spent its cash during the year, whether that be in operations, investing, or financing activities, to allow users to understand how cash is flowed in and out of the charity. What you see on screen there is an example from the existing charity SORP of what a cash flow may typically look like. I don't intend to go into any further detail on the actual technicalities of a cash flow other than raising awareness of what it is. The key change in the cash flow module now relates to the threshold at which charities are required under the revised SORP to prepare a statement of cash flows following the proposed introduction of 3 tiers. The requirement within the existing SORP was that all charities with income of more than £500,000 were required to prepare a statement of cash flows. The revised SORP is proposing to increase this income threshold to £15 million. So essentially a massive increase in the threshold for when you need to actually prepare one of these documents. So essentially any tier 2 charities are probably now going to fall out of having to prepare a cash flow. However, those charities which are classed as tier 1 or tier 2 charities but have income in excess of the small company thresholds, if they're also a charitable company, that's £10.2 million of income, £5.1 million of assets, or more than 50 employees, will still require to prepare a cash flow, even if they fall into tier 1 or 2. So there are 2 different considerations you have to consider there. Whether you are a tier 1 or 2 charity, which would mean you don't now have to prepare this, but also if you're a charitable company, whether you also qualify as a small company, because if you don't qualify as a small company, you'll still have to prepare a cash flow statement. So I think the majority of charities will not now have to prepare one of these if they're tier 1 or 2. And essentially this will just be left to only the largest charities now having to prepare a cash flow statement. There will still be an option to do so if you wish to, however it's not going to be compulsory. SORP Making Body believes that this change will have a positive impact as it will reduce the reporting requirements for more charities. So consultation in this area is essentially whether you agree with the proposals on what types of charities should prepare statements of cash flows. I'll just check the chat, see if we've got any questions in this area. Can I circulate the small company thresholds with these slides? Yes, I can probably make a note to. I'll need to update that because I recognise that I don't have them in those slides, but I can easily update that and include them. So I'll just make a note of that separately.
Now, I think I have moved the Menti to the next question about statement of cash flows, but oh, there is a response there. That's great. I worried that I hadn't done that properly. Rory, 2 people asking us. Oh, about the options, sorry. I have made a mistake here, Rory, and my question says, do you agree with option 1, option 2, or option 3? But I haven't stated what option 1, option 2, and option 3 are. Did you cover that in your presentation, or have I simply made a big boo-boo here?
I think it may be an issue with the question, Kirsten, potentially. I think it's really just consulting on whether you agree with the change to the new tiers in terms of who should prepare them.
Okay, my apologies to those who are helping with the consultation response. This is my mistake, and I don't think I'm going to be able to rectify it quick enough. So let's just miss that question out. And if people have strong views on it, come back to me. But otherwise, I've made it impossible for people to answer that question, and for which I apologise. Yes, that's a great idea. Caroline has suggested, oh, thank you, Caroline. You've saved me yet again. I used to work with Caroline in another job. That people can just put yes or no in the chat as to whether or not they agree that the proposals are helpful or not. So yes, if you think they're helpful, would be very helpful indeed. Perfect. Thank you so much, everybody, for helping me out here.
So I'll just hold off a second before I move on there. Okay. I'll move on just now. I suppose if people still have opinions on that, they can throw them into the chat. I'll move on to the next area anyway. So we've got a couple of the sort of larger changes coming in now, and these are probably the more technical ones in terms of content. So what I'll do is I'll try and address these as well as I can. However, there are a bit of caveats in terms of what is actually being consulted on with these specific areas. The next area of change relates to how and when charities can recognise income in their accounts. So it's all to do with revenue recognition. Existing rules surrounding revenue recognition can be pretty complex for charities. In some cases, it can just be as simple as recognising income upon receipt in your accounts. However, typically there are 3 criteria you need to meet before you can book income. Those criteria are legal entitlement. Is a charity legally entitled to that income? Then we have measurement, i.e. can we measure how much we're actually going to receive? And lastly, probability, is it more likely than not that we'll actually receive that income? Sometimes it's simple, sometimes it's not. It can be a pretty tricky area, particularly in cases where there are, for example, performance-related grants or legacies. In the case of a legacy, it's quite common for charities to be awarded the residue of a legacy, meaning that income can't be recognised until we can satisfy the measurement criteria. We know how much it's for. So it can be complex, as it's a bit of a moving target, really, in terms of working that out. So it's not a particularly straightforward area at times already. The new rules are going to mix things up a bit even more by introducing what's called a 5-step model to determine when revenue can be recognised. This is one of the changes that is driven by the revised FRS 102, which I mentioned up front. The revised FRS 102 introduced the forthcoming changes, so the SORP has to follow this change. That means that the consultation in this area is primarily around the understandability, the application and presentation of the changes to the SORP, as the SORP making body has very limited scope to actually make any changes of their own to this area. Part of the challenge in revenue for charities in this area in particular is that charitable income is often generated in very different ways to income in a commercial entity. Whilst most companies typically sell a product, often under a contract or legal terms, many charities often receive income from areas such as donations, legacies and grants. There's a distinction between income, which is considered to be an exchange of goods and services, and non-exchange. So non-exchange, typically things like donations, legacies, where the charity is not giving something back in return. Exchange being where the charity receives income, but they are giving something back to the individual in return for that. So there's a distinction between that exchange and non-exchange there. So to accommodate the extra detail on exchange transactions and to assist users of the SORP to identify what's relevant to them, the module has now been split into two main sections. First section deals with exchange transactions, and the second section deals with non-exchange transactions. Income from exchange transactions, as it says, received by the charity for goods or services supplied under contract with a third party. The new 5-step model, which I referred to and I will show on the next page, applies to exchange transactions only, and therefore a contract must be in place in respect of these two rules. This 5-step model that is being introduced, funnily enough, there are 5 different stages to it. So what you have to do is identify the presence of a contract with a third party, identify any performance obligations which are built into the contract, determine the transaction price associated with the contract, i.e. how much is the charity going to earn as part of this contract, then allocate that transaction value to each performance obligation, and you then recognise that amount of revenue as you satisfy each performance obligation. So five steps to be considered there. This may apply to, for example, provision of educational services by a charity in return for course fees, or the provision of serviced residential accommodation by a residential care home in return for payment, or a service level agreement, for example, where a contract is in place and a charity delivers services over time. So where that is the case, the charity is going to have to determine what it's going to have to deliver as part of that contract and recognise revenue as each of those performance criteria are met. This is a bit of a complex area, which is a lot of detail in the SORP, and it may require a bit of an expert understanding or advice to apply in full. And the primary aim of the consultation is to determine whether the 5-step model is clear and understandable, and not, as I say, whether this should be applied in the first instance, because that is a given. This is not going to change. In terms of revenue recognition as well, there are some further revisions to the treatment of legacy income as well. It's been revised in accordance with the principles in FRS 102 and to reflect feedback received from engagement strands that there were issues with understanding the accounting treatment in this area and a lack of consistency in charity reporting in respect of legacies too. Income from legacies must be recognised when it's probable that the legacy will be received and its value can be measured reliably. Some of this criteria in the SORP have been updated, and we now consider probability as when there has been a grant of probate, or in Scotland, grant of confirmation, when the executors have established that there are sufficient assets in the estate after settling any liabilities to actually pay the legacy, and that any conditions attached to the legacy are either within the control of the charity or have been met. There is also further clarification that legacy income must be recognised only when it can be reliably measured, and the consultation is looking to see if this guidance is clear and understandable, and also if it would be beneficial for less familiar users to be provided with separate guidance on the treatment of legacy income. So in respect of consultation questions in this area, 3 areas which I think we're going to cover in the Menti poll, which is, are the requirements of the 5-step model clear? Are the accounting requirement for legacies clear? And given that accounting for legacies can be a complex area, and even as someone who deal with it in a day-to-day, it's not easy to apply at all times, is there a need for further guidance on this topic? There are also a few areas of the consultation which can be answered separately if anyone wishes to do so. Do you find that the module is easy to navigate? Do you consider the guidance on exchange and non-exchange transactions should be set out in separate modules of the SORP rather than separate sections of the same module? And in the exposure draft of the SORP, all disclosure requirements are listed at the end of each module. Would it be clearer instead to set out the relevant disclosures at the end of each section within the module? So a few there which can be answered separately, but the main people covering areas at the top.
So a couple of people have responded here on income recognition, asking for extra examples. That seems to be, seems as if that would be very helpful. So I'll move us on to the next question there. If anybody's got things to report around legacies, I see in the chat that somebody's put in a request for extra examples there as well. So I can pick that up and move that over in terms of the Menti as well. But if anybody else wants to add, please do so. And then I can move on to the third question as well, if people have thoughts. Francesca has a question there in the chat, Rory.
Yeah, about whether it'll impact on the number of those offering independent examination. It's a good question. Personally, I think, and this is based on nothing other than feel, I think there may be some where they provide them. There's obviously a distinction in the independent examiner landscape between those who deliver it as an individual. So, for example, a part retired accountant who does it because they're qualified to do so, and those firms who provide independent examinations as part of their services. I think, based on nothing other than feel, that some of the individual independent examiners may see these new rules and just think, you know what, it's not really worth the hassle of me having to actually implement these in the first place. But that is really guesswork. I don't think it'll impact on accountancy firms providing this service, because it's something which we're all going to have to understand and implement anyway. It may impact on costs. I wouldn't be surprised if there is a bit of a significant impact on cost here, because there is quite a lot involved in these revenue recognition criteria, and there's also quite a lot involved in the leases, which I'm going to come on to in a minute. So I wouldn't be surprised if it impacts on cost, and I wouldn't be surprised if there is some reduction in the delivery by essentially self-employed individuals or retired accountants who deliver that service. But I could be wrong.
I guess just to add to a little bit of the other background around access to independent examination and also to audit is the rise in the audit threshold. So part of the impetus, although only a part of the jigsaw for us lobbying to raise the audit threshold, was around access to audit, which organisations were finding difficult. But of course, taking people out of audit threshold also increases the need for the number of independent examiners. So it's not without its challenges, and just sort of to reassure people that it is also on SCVO's radar in terms of that, the importance of that impact to access to independent examination and to audit. We've asked some questions about that in the Scottish Third Sector Tracker, and we'll continue to keep an eye on that so that we can raise that in the relevant places if it does continue to be a challenge. I think we've probably got what we're going to get there in terms of answers on the Menti, Rory, so happy for you to move on if others have questions, although Zoe has asked a question about the planned audit threshold, so you're probably better placed to answer that than me.
Yeah, so the planned audit threshold will be £1 million. It currently sits at £500,000 for charities, but that will be increasing to £1 million. In terms of timeline for introduction of that, I'm not 100% certain. I think that's still to be decided on, but hopefully in the near future. Obviously, you mentioned that it will be in line with England. There is some suggestion that in England and Wales they are actually looking at raising it there. I think there's been some chat they're looking at raising it to £1.5 million in England, but my gut says that won't be the case in Scotland. I think it will sit at 1 million when it increases, and if there is a change in England and Wales, I don't think it'll follow that.
That's certainly Scottish Government's intention. So unless that was to change on the way through Parliament, which would be unusual because of the type of regulation that it is, then my understanding is that it'll sit at 1 million.
Yeah. Okay, I will move on. There's only a couple of sections left to cover. This is the last big area of change, and that's pertaining to leases. At the minute, there are two types of lease in the accounting world, which are operating or finance leases. There are lots of criteria to distinguish between what is an operating and finance lease. However, most simply, finance leases are ones where you tend to hold the asset for a significant proportion of its operating life. So it's something like a car. Usually you'd expect a car to last for 4 years, for example. I know they can last longer than that, but that's roughly how long they last for. Usually when you lease a car, it's for the majority, if not all of that useful life. That tends to be a finance lease. Operating leases are for shorter term leases. So that'd be things like IT equipment, photocopiers, office rental, where you only really lease that equipment or asset for a shorter period of its lifespan. So again, an office rental, you might expect an office to last for, I don't know, 50 years maybe, but you might take out a lease for 5 years. So it's only a short-term proportion of its life. There are various other factors that come into play, but that's one of the most common ones. Operating leases are probably more common for most charities. Accounting for them is pretty simple too. Currently, we just account for any payments as an expense when they're incurred, and we show how much we're due to pay over the rest of the lease term as a note to the accounts, as is displayed on screen there. We don't recognise the leased asset in question on the balance sheet, as we don't legally own it, and we don't include the amounts we're due to pay as a creditor in any way. However, that is all now going to change. Going forward, we're no longer going to be keeping these off the balance sheet. We'll need to recognise future payments under the lease term on the balance sheet. You're going to have to show future lease payments as creditors, both as short and long-term liabilities. The offset of that is that the assets which we held under operating leases can now be shown as a fixed asset, as what's called a right of use asset, and that'll be depreciated over the lease term like any other fixed asset is. There's also a requirement for charities to consider what's called the time value of money, and I think this is where this starts to get quite complicated. The time value of money recognises that due to interest rates, inflation, the value of payments that you make in the future will not be the same as the value of payments made at the start of the lease term. So, for example, if you think about £100 today, that's worth more than £100 will be in the future. Because of interest rates, inflation, typically the value of money goes down over time. So as such, there will be a requirement to determine an interest rate, discount future transactions, and split the payments over the lease term between a deemed capital and interest element. And as such, this is again going to be a potentially complex area. The SORP making body recognise that this is going to be challenging for charities to comply with. So here's an example of how the balance sheet might look in simple terms going forward. Under your assets at the top, you will now see a right of use asset. In this particular example, it's £20,000. Down the bottom, you will split the associated payments between amounts due in more and less than 1 year. So in this particular example, the amount due in 1 year is £10,000, and the longer term proportion is £10,000 as well. So they will roughly balance out with each other. The actual impact on your balance sheet by bringing the asset on and the associated liabilities will not have a significant impact on the net assets position. However, it is important to recognise what it may look like. Is this going to apply to all assets that your charity leases? Technically not. There are some exemptions from this treatment for what's called low value assets, but these are likely to be minimal and will only apply for assets which are less critical to the business. So for example, things like photocopiers, or where you're hiring the asset for around 12 months or less. There will also be updated disclosure requirements too, to provide more open and transparent reporting on the nature and extent of leases, and to allow users to understand where and why the charity leases its assets. Again, the SORP has to mirror the requirements of FRS 102. And because these changes have been brought in by FRS 102, there's very limited scope for the SORP making body to actually change any of these rules. Again, these are sort of being foisted on them to some degree. So the consultation is therefore focusing on whether the changes are understandable and whether the guidance is clearly presented. So the consultation that we'll be focusing on with the Mentipo is, are the requirements for lease accounting clear? And if not, what are your questions? And then separately, you can answer in your own time whether you feel that the full module is easy to navigate as drafted. There are some other areas about leased assets significantly below market value, which I don't feel is particularly relevant for this today. And there's some additional disclosure requirements as well, which again, there's about 30 new clauses, which again, I don't want to bore everyone with 30 different disclosure requirements today. So those can be reviewed and answered in your own time if you wish to do so. However, the question is primarily on whether the requirements for lease accounting are clear. I don't believe I've had any questions in respect to this, but if there are any, I'll answer them as they come in.
The comments coming in so far are suggesting that this is pretty complex, and that people maybe feel like they need a bit more either reading or support from an expert in order to fully wrap their heads around it. So it might be that that's why we haven't got any questions as well, that actually it's too complicated to ask a question.
Do you know, I mean, from a personal point of view, I completely agree. I mean, as someone who it's my job to be aware of these, I've been to several different webinars on this. I've looked at various different bits of paperwork, and I don't really feel that until we get going with applying this, that it will become abundantly clear how this is going to work in practice. I think as a layperson, this will be very, very challenging to implement, and I think there will be a lot of charities who have to rely on an auditor or independent examiner to be able to apply it properly, which I think it comes back again to the point that we addressed separately about costs. I think this is inevitably going to have an impact on the cost of audits of independent examinations. There's no point in pretending separately that it won't, because there will be that reliance on external guidance for this.
So as much as I think that's really challenging for people who were hoping to come away with some nice clear answers today about what they need to do to get their organisations ready, at this point in the process, it's really useful feedback for us to be able to put into the consultation that there are these areas where people are feeling that they're going to be really reliant on external expertise and support, and where it's going to be really difficult for them to get themselves up to speed. So we'll certainly be able to put that into the consultation. And it's also, I think, really been a great reminder for me today that this is another aspect of charity regulation and the impact of that on organisations and on funding, which we should be making in relation to all our fair funding work as well. So although we obviously knew that, this has really brought it to the front of my mind that this is yet another, I am going to use the word burden, on voluntary organisations who are really struggling. So we can certainly do what we can to increase awareness of that. There's another question there for clarification in the chat, Rory.
Yeah, it will apply to all three tiers of charities. So this is going to apply to everybody. There's no get out, if you like, for smaller charities. So unfortunately, that is the case. I mean, the only thing I might say is I think it may quite commonly be the case that a lot of smaller charities, those that are under tier 1, may have more assets that are determined as short-term or low-value leases. So that would essentially give them a bit of a get out in respect of that, but it applies to everybody. Do you want to move on just to the final area? That's fine. So there's a bit of an irony here in terms of what we're covering, but just the last area is just there's some consultation on the requirements for smaller charities, and it's the application of new rules for smaller charities. One of the recommendations from the SORP governance review was that the needs of smaller charities should be better served by the SORP, and reporting requirements made more proportionate where possible. The needs of smaller charities have been considered when developing the SORP against the need for charity reports and accounts to provide adequate information to stakeholders. If we think back to the tiering system discussed at the start, there are a number of clear exemptions available to small charities in terms of reporting in their trustees report. We have the tiering system allowing reductions in content for those that are particularly falling into tier 1, but also to some extent tier 2 as well. We have the natural basis of classification of income in the SOFA, which allows more meaningful reporting of income and expenditure for those tier 1 charities. We also have things like the cash flow exemption 2, as well as a lot of other areas of reduced reporting for small charities, such as, for example, disclosure of trustee and staff remuneration and related party transactions, which I haven't specifically touched on today, but do fall for smaller charities. On the flip side, obviously what we've just discussed about revenue recognition and leases possibly counteracts that to some degree, but I think that isn't something that the SORP making body have a particular amount of control over. So I think that has to be considered slightly separate, because again, as I say, that's foisted upon them. For small companies, there are a lot of other disclosure exemptions available which have never been permitted for small charities, even before the revised SORP, which are known as FRS 102 1A exemptions. So that's for small companies rather than small charities. It's always been felt that there would be little practical benefit of developing a SORP on the basis of section 1A of FRS 102, as it would require significant additions to meet the transparency and accountability expectations of relevant stakeholders. So consequently, the SORP making body have concluded that FRS 102 1A is not suitable for charities, and therefore the SORP continues to not permit the use of these disclosure exemptions which are available to small companies. The consultation piece here is particularly keen to ensure that the new SORP requirement meets the needs of smaller charities, and that those of you from smaller charities may wish to respond to the 2 final questions that apply specifically requirement to smaller charities. Do you agree that the drafting structure and proposals in the revised SORP supports the needs of smaller charities whilst addressing the needs of users of charity reports and accounts? And do you agree with the SORP making body's decision to continue to disallow the application of section 1A? So those are the 2 consultation areas which I think we're focusing on with Menti.
I somehow have managed to lose the Menti slide. Really don't put me in charge of technical things ever again. So if people have comments on this, it would be terrific if you could put them in the chat. I'm fairly sure I can mind read, and I know on the basis of other conversations that have happened so far and other comments how people feel about this. But if people could pop some comments in the chat, that would be much appreciated. Just to pick up on Rona's comment there in the chat about a need for appropriate support and guidance. Certainly on the back of today, I'll be talking to some internal colleagues about how we can continue to support on this as well, because while we're not accountancy specialists, I know that we will get lots of questions to our information service and things about these. So we'll be working with other partners and with Rory again. I no doubt, I'm just going to sign you up in public, Rory, so that you have to smile and nod and say that you'll be happy to help us again. But yeah, it definitely feels like there is there's going to be a need for support on an ongoing basis here, particularly once this ceases to be a consultation and it's a bit clearer exactly what which bits are required. Although I think most of the bits that are really complex are coming anyway, aren't they? Because they're part of FRS 102.
Yeah, I mean, I must admit, when I was reading the initial information that was coming through about it, I mean, obviously these changes have been in the works for a while. Obviously, had a bit of a steer when the revised FRS 102 came out last year, and I was immediately reading it and thinking, well, I hope that there will be provision built in for smaller charities to get out of some of these, but I think the more complex areas, unfortunately, there aren't. And I think it is just a factor of the fact that the SORP making body really can't provide exemption from these for smaller charities. So I completely sympathise with the smaller ones out there, and I think it's likely that there will be a lot of leaning on independent examiners, auditors to assist with this process, which I think inevitably for most organisations may lead to increased costs of compliance. So yeah, I do sympathise in a lot of ways with that.
And I think just to pick up on Kevin's point in the chat there, he's saying that the questions that are being asked are all well and good. And so just to be very, very clear, these are the consultation questions that are set out by the SORP making body. So we've just replicated them. But I think Kevin's making the point that we've got to think more about the practical implications of that. And that's certainly something that we can pick up as SCVO in our consultation response and make sure that we're making that point pretty forcefully. I'm not 100% sure that making it to the SORP making body is the right place, as in a lot of ways their hands are a bit tied, but we can also obviously be making it in other places with funders and others as well. So I've heard that loud and clear today, and that's definitely a message that we can take forward.
Okay. I mean, from my point of view, that's essentially everything in terms of technical content. I mean, I'm happy to address any sort of general queries on technical content at the end if anyone's still got any questions. But
okay, fab. If anybody does have any questions, now is your chance. So any other questions, do please pop those in the chat, or indeed unmute and make yourself known. I think the comments that are coming in are just more general in nature rather than questions. So I'll just slowly start to wrap up, and if a question comes, just shout me, Rory.
Yeah, of course.
So yeah, just to confirm, we'll send round the slides. We'll send round in due course a link to where you can watch this again if you wish, or if you want to show it to your colleagues or whatever. I'll also send round the results that came from the Menti and also the comments in the chat, not in full, but just so that you have a sense of what's going to inform our consultation response. And the consultation response will be available on SCVO's website. If you do want to particularly see that, just drop me a quick email. We'll also circulate the information on small company thresholds. I'll hold Rory to that since he said he would. My colleague Tracy has put a link in the chat there to an upcoming webinar on the changes to charity law. So if you are interested in that, then do please sign up. And otherwise, just to say a really big thank you to Rory and also to Tracy, who have done all the work to get this organised. As SCVO, we'll definitely be having a look at what other support we can continue to provide in this area. And from me, thank you so much for all the information that helps me to write a consultation response. So yeah, fabulous. Thank you so much. And if you need anything, you know where we are at SCVO. Thank you. Bye-bye.
Thank you.